The United States just ended a streak that is the second longest in United States history. For those at home, we have been around since 1776. So it is a long time. And we just had a global shutdown of the economy not too long ago with the cerveza sickness. So seeing job growth end now, just after the entire globe shut down, it should be alarming to you guys, folks. And I've been telling you guys on this channel for a while about the potential of this job crash and how the consumer is hurting. We are going to get in why this streak is significant, what other layover effects we're seeing, including some negative effects laying over in housing, and much more. But first, let's get into this streak here. And as you guys know on this channel, I've been covering this for quite some time. So make sure you guys are subscribing if you haven't already. But the U.S. just officially ended its second longest job market gain in U.S. history at 53 months because it had that downward revision. Now, we saw the 2010 to 2020 expansion go dummy, as the kids say at home, but it's worse than you think because we literally had the entire globe shut down. Everybody said widespread layoffs, increased unemployment, followed by a strong recovery and a great resignation where workers left their jobs, leading to labor shortages because there were so many jobs all over the place. But the reality is that all of these layover effects, just like housing, well, everything got a little too fat, as some might say. So we just need to trim off some of that fat right now, and we're seeing a massive amount of job loss here, which is not good and not a sign of a healthy economy. So with that, right, the massive layoffs and unemployment, and there's been an uneven impact, right? There was leisure, hospitality, all of these things. But hey, workers were reevaluating. Many workers used those pandemic as an opportunity to reevaluate their careers, leading to significant number of people leaving their jobs. But it attracted a bunch of increased wages because of the amount of money that they were just pouring in. And then there was a big industry recovery with prime age labor recovery. So there was a big giant effect in both private and public employment, as we all know. Now, these layover effects have been coming in, and everybody's been seeing the massive amounts of job growth. And now, after that, right, 53 months of straight job growth. Then boom, all of a sudden now jobs revision, and we're losing literally 1 million jobs lost in this revision. So it's absolutely insane. The numbers that we are seeing now come from this layover effect, right? So we're going to continue to see that and watch how the consumer is going to be hurting because, hey, now just 22,000 jobs were added. But who knows after this point, because we've seen some dramatic revisions of June and July. So Trump fired the top Labor Department official over accusations of releasing inaccurate data because we see such dramatic revisions. Look, I mean, either way, the slowdown is not positive. So the Bureau of Labor Statistics reported that the U.S. added 22,000 jobs, well below the expectations of 75,000. Now, that's a giant increase that we're seeing here, or a giant decrease, excuse me, a big gap between what we thought we would see and the overall numbers. And we normally see these revisions come in, and they come in pretty hot here. So they've taken together, the U.S. has added 598,000 jobs this year compared to the 1.1 million of last year. So literally cut in half, basically. And the unemployment rate is higher. The number of adding growing concerns. Everybody's saying, oh, it's, the tariffs, this, tariff, that. But the reality is it's all the inflation, the layover effects that we're seeing come to roost here. Because when you print, 40 plus of the money supply in QE since 2020, well, you know what? These inflationary concerns are going to come through, right? So we're going to start to see that, over time. So we are seeing this dramatic increase of unemployment numbers, and we're not seeing the jobs and the labor and the wage growth, continue to rise up like many had predicted. Now, with that, right, there's been a lot of debt struggles from the consumer as well at all income levels. Quote, it's a tipping point, which is ironic because of how much tipping is in the news these days, because everybody seems like, hey, you need to tip. Oh, whoops, I need to share this tab. Everybody says you need to tip for literally every single service. So over the past 6 months, these debt issues have continued to grow, and it really doesn't matter on the income level, which is crazy. So no matter what, everybody is feeling the effects. And this shouldn't shock anybody because of what we, continue to see here, right? With the amount of money we start to see coming in, out with all of, the United States, well, hey, the government bailed out millions of companies not too long, or hundreds of thousands of companies not too long ago, and they sent money everywhere. And now inflation is coming to roost and credit card debt's tricking higher. They had pauses on student loans. We're seeing delinquencies rise up through the roof. I mean, it's just the overall number of debt is just skyrocketing in flight. And it's something that we're seeing here, right? Consumer debt drives legal stress to a 5-year high, which is insane, right? So these foreclosure indexes going up, the finance index is going up. Foreclosure inquiries rise 30% year over year as Americans struggle to stay afloat. Personal finance questions up almost 9% in the first quarter. And legal inquiries are nearly 30% year over year. Mounting consumer debt push Americans to seek legal help at the highest rate since November 2020. Now, according to this new data that offers an early warning sign of household financial stress, well, we're in trouble here, folks. The combined 4.4% in March, driven by surging foreclosures and the customer finance legal inquiries. Well, debt is a common thread between rising consumer stress. The senior vice president said whether it's missed mortgage payments, maxed out credit cards, or mounting buy now or pay later balances, debt-fueled household spending is forcing people to ask a lawyer for help. And now the housing market has shown a bunch of mixed signals, as I've been showing you guys a bunch on this channel. So make sure you guys are subscribed here. But the housing has seen, levels that we haven't seen in like 50 years, seeing levels worse than 2008. New home construction saw a notable jump, but everything else, man, the prices are too damn high. We just need it to come on down. Days on the market, medium days, is up 7 days since the last year. Existing home sales with 2% increase. And these new home prices are generally flat, with new construction rising 5%. And they were down 13.5% last year. But on the positive, the supply is increasing. There's builder incentives. But they're just people sitting on the sidelines. The amount of mortgages under contract is at 30-year lows. So this is worse than 2008, folks. We're, 17 years from 2008. So if you're saying it's the worst in 30 years, well, it's worse than we saw in the housing crisis, right? So not exactly positive things out of there. But you know what? At this point, Jerome Too Slow Powell in just about 11 days. Looks like it's a 90% chance or 100% chance to cut rates, 89% chance to cut 25 basis points, and now an 11% chance to cut 50. And that 50 is starting to crank up a little bit. So we're going to continue to watch and monitor how this is going to play out. Even though we've got a very weak Dixie at 97.7. And look, I get it. It's the weekend. You know, this isn't necessarily the top line of what is all going on. But hey, the reality is that the dollar is still extremely weak, even though we have the Dixie at this level. Excuse me. Of course, the dollar is weak with the Dixie at this level, even though everybody is saying the economy is doing well, because if you look at the S&P 500, we're just under the all-time high at 6,500. And we could crank above that here this week. So even though this is the case, we've got the dollar at a very low level. We've got inflation running hot. And the reality is that the consumer is struggling. And I'm going to be detailing all of this. So make sure you guys are hitting that subscribe button, telling a friend to tell a friend. And this is a short Saturday rip. So thank you guys all for coming out. And I'll catch you guys all tomorrow.